Hello and welcome to a fresh new edition of Taking Stock. This is the show where we review the week which has gone by, but more importantly, as always, we try and prepare you for what lies ahead. I think the week which has gone by itself has been a very, very tough one. And it's not just this week. The last one wasn't any better. Can the week which is in front of us be any better? Will things improve? That's the big question. What will lead it to improve? I am Prashant Nair. With me is my colleague Surabhi Upadhyay. Hi, Surabhi.
Hi, Prashant. Well, the only thing that improved this week, I think, was a profit for the Bears because it was an out-and-out down week. Let's quickly rewind back and look at the last 5 trading sessions and get that context in before we introduce our guest on the show. So as I've been saying, it has been a down week. There's no denying that. And particularly the kind of momentum that we saw in the selling on Thursday and Friday, that really would have rattled a lot of the bulls out there. So what are the highlights of the week gone by? First and foremost, the selling has now well and truly reached the large cap space. Once again, we saw stocks like Bajaj Finance, the bluest of the blue chips, come under pressure. The selling has also been relentless towards the end of the week. What we saw was a lot of the levels sort of break down on the lower side. The market did close below its short-term trading range. It lost the 11,460 level. In fact, it barely managed to hold on to 11,400 on the Nifty. And the other facet that is interesting is that it is across-the-board selling. You don't have banks which are willing to now bat for the bulls. You're not getting that kind of leadership even from IT, barring an Infosys maybe this week. The problem is, where do you really hide? The fact that the government has really stood its ground on the FPI surcharge issue, that seems to have really spooked the bears, and that perhaps was responsible for a lot of the FII selling that we've seen and the big fall that we saw on Friday itself. I'll quickly talk about the earnings, and here the picture is also slightly muddled. It's very clear that the slowdown, the credit crunch is now beginning to take a toll on companies and then lenders to those companies. Take a look at what RBL Bank, for instance, had to say. They had a great first quarter, but their guidance about the coming few weeks and months was really telling. The stock was down 13% as they acknowledged that asset quality could get worse. The bears are still having a field day on auto stocks, and wherever there are earnings disappointment like Mindtree, these stocks are not getting spared. I would, however, like to conclude with the silver lining of the week. You did have numbers come in from, let's say, an Infosys, as I mentioned, even Dabur, decent numbers, better than expected volume growth. So the hope really is that there'll be more good earnings than bad. And the hope as we finish this week is that the bulk of this disappointment on the FPI matter, perhaps that's over and done. And maybe, just maybe, the market will be able to move on beyond that. But that's exactly what we will discuss with our guests on the show. As we get to that, let's just quickly run through the week's stock movers and shakers. Mangalam has that lowdown.
Well, this week was all about losers in trade and not gainers. The mid-cap index not doing too well. The Nifty also losing about 1%. So some of the big accidents that we had from the frontline space this week, starting with Yes Bank, big hole in their asset quality, as well as funding woes took the stock lower by about 12%. M&M, Eicher Motors, Hero MotoCorp, auto stocks not doing too well, and now that percolates down to two-wheelers as well. All of them hit their 52-week lows. Apart from that, we had gainers coming in. In fact, ICICI Bank, L&T also lost. But let's talk about the gainers. The biggest of them all was Infosys on the back of a blockbuster showing as far as their first quarter numbers are concerned. A double upgrade coming in from Morgan Stanley took Sun Pharma higher as well. And we saw good gains come by in Wipro despite a muted quarter, primarily on buyback hopes. But it was the broader markets where majority of the pain was, starting it out with RBL Bank, with the management cautioning the street for the next couple of quarters. That stock was lower by 22%. DCB Bank not doing too well as well, and weak numbers coming in from Tata Elxsi and Cyient. Both these mid-cap IT stocks shed about 10 to 17% of the weight of the company. Price wars in the battery space took Amara Raja as well as Exide lower. We also saw a big 5% cut on Biocon as one of their competitors launched trastuzumab before the company itself, and then a sharp cut on some freak names like HEG, Talwalkar, etc. Some stocks which gained a few shades of green. We had HDFC, AMC on good numbers, high by about 18%. Thermax, they won a couple of orders. That stock was high by 6% as well. And then we had IGL and Greaves Cotton, both of them higher by 4.5%. But suffice to say, losers were aplenty, winners far and few in between.
Okay, Mangalam, thanks very much for that. So that's essentially a wrap out of what happened as far as this week is concerned. But before we bring in our guest, who's Pramod Gubi, I just want to highlight just 4 or 5 points which will be important to track in the coming week as well. You know, I began last Friday's show, also with talking about how the global picture is a lot more supportive as compared to the local picture. And that is exactly what has kind of sort of panned out. If anything, the global picture for risk assets seems even more positive. On Thursday, we had probably the two most important people on the FOMC, the rate setting committee of the US Federal Reserve, sounding even more dovish, if that is possible. So you had the New York Fed president and the Fed vice chair sort of essentially saying that it's better to do rate cuts rather than sort of be sorry later. I mean, I'm just paraphrasing, but the broad message was that rate cuts are needed and they're needed now. Remember, the Fed meeting is not until the end of this month, so it's only the week after the next one. But I think many in the market are now looking at these statements by these two to sort of mean that maybe the market can expect, realistically expect even a 50 basis point cut in the month of July. You saw the reaction to these expectations on Friday. Most global markets were higher. I mean, India actually was one of the only losers and big losers. Otherwise, I mean, there was essentially a wave of green across most global markets. So that is the global picture. And, that remains very, very supportive. A couple of other things, and these broadly over the last couple of weeks that we've been highlighting remain unchanged. The yield curve in the US is still inverted. There is still, it looks like, yields across maturities have meaningful downside levels to go. And the picture for the US dollar also remains pretty bearish. Not exactly a bad setup for risk assets like stocks, so as to speak. But the fact is, as we've been pointing out, it is the local which has essentially been trumping this global dovishness and this global appetite for risk assets. And that we saw the week which has gone by, and we saw this over the last couple of weeks, actually. I don't think, there is anything out there which can really change sentiment, turn sentiment to be more bullish in the coming week. The budget is behind us. Expectations that the government may do, those have become more and more bleaker. So I think we are approaching this new week once again with a global environment which is supportive, if only the local factors in a way get out of the way. Surabhi.
Okay, well, so that's how it's stacking up in terms of global and local cues. Let's take the conversation forward. We have Pramod Gubbi, co-founder of Marcellus Investment Managers, now joining us on the show. Pramod, so lots of cues, more down than up. That's what the week seems to be telling us. But first things first, is the budget disappointment now fully in the price, whether it was the tax issue, whether it was the lack of any specific stimulus? Are we truly done with the reacting to the budget bit?
Yeah, I think to the extent that these were expectations to start with, I think they tend to quickly get priced in. It's just that now we don't have a trigger to look for in terms of for macro, and naturally attention will turn to the only things that are supporting, which is fundamentals. Unfortunately, we haven't had a great story to tell on that front, at least for the last 3 quarters. And hence, despite a strong liquidity, as you guys have been talking about, particularly the global liquidity situation looks like getting more and more benign, which should have been a positive for the market. We have seen that not supporting as well because, at the end of the day, you will look for support through fundamentals, and that's not coming. My sense is you will see a recovery. You will see a recovery, particularly driven by liquidity itself, while fundamental recovery might take some more time. I don't think even some of the measures taken in the budget will likely address some of the liquidity issues globally, which are fueling rather locally fueling the economy. Will take a couple of quarters to show in terms of growth picking up. So until then, I guess it'll at best be taking support of the global liquidity situation.
Is there something which can turn sentiment around, Pramod? Or you think it's kind of one way? If anything, things seem more bleaker every passing week.
Well, I'm afraid there's nothing on the horizon that can turn sentiment. Sentiment, I guess, like we said, we've talked about all possible catalysts that could have happened, including the budget, some announcements. We also discussed the budget perhaps is not a forum in its entirety to make all sorts of policy announcements. Now, I'm sure there are plenty of announcements that the government come up with in terms of long-term policy changes. However, none of that will make a difference to the short-term fundamentals. But from a sentiment booster, it is quite possible. We have seen that the government is keen to look for reducing costs of factors of production, for example. We've seen a clean set of measures which has really focused on attracting foreign capital, reducing the cost of money in the country, leveraging from the low cost of money globally as well. And also we've seen some measures on the labor front. So I think the government is thinking on the right lines. So I won't rule out further such measures which put in long-term policy changes, which are perhaps much more appreciative from an investor perspective. But I don't think there's anything within the realms of the government or anybody to turn the growth situation around. It is likely to take some time, maybe a couple of quarters, if not longer. So you're right. We have to look up to a sentiment change for a pickup in the market. But the good thing I'll go back to is the global liquidity. Global cost of capital is coming down. We have seen enough evidence. In a surprising move yesterday, the Fed clarified the statements. Notwithstanding that, I think we are headed towards further rate cuts, perhaps steeper than 25 bips that we've seen.
Okay, so that's our one hope. But then again, to come back to what companies here at home are saying, I mean, look at some of these smaller banks. They have really caused a bit of a flutter in the market, right? After DCB's numbers and then RBL Bank coming out and saying that some of their clients have been impacted by liquidity, so maybe that will lead to some asset quality stress. This was not really factored in because banks were supposed to come out with a pretty smooth set of numbers, and now we have unpleasant surprises here.
Yeah, I think there's a little bit of overreaction from the market standpoint. I don't think the RBL numbers were that bad. The guidance and the commentary was a bit cautious. Numbers were fantastic, actually, yeah, but the reaction won't suggest. Yes. Same thing with DCB. I think the disappointment was perhaps marginal at best. It was not talking about any serious asset quality stress. The trend that you're seeing is for every small disappointment, the reaction in the market in terms of the stock price is disproportionately much steeper. Yeah. So that's a suggestion that the sentiment in the market, the liquidity is not supporting. And as a result, small disappointments can cause big changes in stock price. This is a classic situation of a market which is desperately looking for support and a sentiment booster somewhere else. But having said that, I think it is quite natural to see further stress in lenders coming in because more often than not, a growth slowdown just exacerbates the asset quality situation, right? A lot of businesses across the country run on leverage. When growth disappears, the leverage cuts you downside, right? And that's what you will see in NBFC books, in small banks books who are exposed to such lenders. So we need to do something to get the growth back up. Unfortunately, there is no magic wand which will help you get the growth back up in the near term. But until then, if we can see some more long-term policy measures, we might see a sort of a downside support there.
So just picking up on that point, do you think people will revisit that assumption that NPLs have peaked, etc.? Because, I mean, this will show up not just in smaller banks and NBFCs, but, I mean, everywhere, right?
Well, I think there are two different sets of banks out there. I mean, perhaps the big legacy corporate project finance related stress, we might see the bottom. I don't think we have seen much project finance activity in the country in the last 6 years, other than perhaps a few roads, which have been very well funded. I don't think there's any stress coming in. But
there could be new segments, right? I mean, what we know, we already know. But I mean, there could be new stuff, not just project finance, but
right.
I mean, people have also pointed out to personal loans, I mean, as a category, individual loans, etc., which banks have chased, ignoring project financing, etc. That pressure could emerge there if a growth slowdown continues.
No, quite possible. I think more than personal loans, I think at least from the lenders that we sort of cover and track, we don't see any severe stress on that front. It's not like we're in a dire situation with job losses happening across the country. Yes, job creation has been slow, but I don't think you will expect stress coming from that side. Where you could see stress is naturally from SMEs. SMEs are the ones who are in the supply chain, who are operating, who are dependent on working capital financing to keep their growth going. Some of them have working capital loans, and if the growth doesn't transpire, their ability to service those loans and repay those loans get constrained. And that's the sort of stress that you're likely to see. So any NBFCs or small banks who are exposed to SME lending, perhaps you'll see incremental stress which is not already factored in by the market.
Okay. Well, the glimmer of hope this week were just one or two numbers, I think, and Dabur was definitely one of them. Very smart 9.5-10% volume growth, but yet the stock didn't shoot up on the back of that. So how do you interpret the market's sentiment towards consumers, staples, and would you look at them as a hiding place now?
Well, it's always been a happy hunting place for us. Like I've talked about, this is one sector where the structural demand is intact. I mean, if we give up on the demand in this sector, I guess there's very little to look forward to in this country. So lots to play for from a long-term perspective. Of course, there is a slowdown. We've seen some of the channel financing issues will hurt the staples as well. If not at the end user level, the distributors' offtake of inventory, the wholesalers' offtake of inventory will show up in the weak numbers which we are seeing. So while Dabur might have been an exception, I think the experience of the last quarter where we saw pretty much across the board staples reporting perhaps mid-single digit volume growth, some of them almost flattish. So the market will wait to see if Dabur is an exception and the others can report better results. But from our perspective, I think we will continue to be positive on this sector, partly because of our long-term view. Partly because of, I think the companies in these sectors are still much better prepared to face a slowdown. They have deep competitive moats and are very well positioned to ride on the secular trend. Now, if the secular trend is questioned, it's a completely different matter. But for now, I think consumption is one place that will hold a large part in our portfolio.
Pramod, if you were handed a pot of money and said, well, invest, would you do it now? Would you wait?
No, I mean, we all believe in not being able to time the market. We have absolutely no skill in that. So as a result, we would rather deploy the money now and put that money to work as early as possible. Remember, equity is perhaps one asset class which is upward trending in the long run because it's reliant on earnings growth. And earnings growth generally is upward trending, particularly for companies which are exposed to a secular demand trend and at the same time have very sustainable competitive moats. So, and as a result, there's no point in us second guessing when the recovery will happen because we might miss it when it actually happens. So we would rather deploy it, put the money to work, as long as the companies in our coverage universe are trading at prices which are significantly lower than their intrinsic values. So that's the only thing that we're worried about.
That's the key point.
All right, Pramod, it's great to talk to you. Thank you so much for taking out the time and joining us on the chat this week. Well, on that note, we need to take a break. But before we hit that break, let's take a look at some of the major events that will probably determine the course of the market next week. Anisha is here with that list.
Oh, well, yes, it promises to be a very busy week, at least as far as earnings is concerned, because on Monday itself, we have the big banking name Kotak Mahindra Bank that will be reporting its numbers. DHFL also has an important board meet, so we'll keep an eye out on that one. And TVS Motors also will report numbers on Monday itself. On Tuesday, we have the big boy from Infraspace, Larsen & Toubro, as well as HUL that will be reporting numbers, and Z Entertainment will also come out with an update. The street will watch out for that. Apart from the numbers, is there any update coming in on the impending deal? On Wednesday, we will watch out for earnings from Asian Paints, IDFC First Bank, Jubilant Foodworks. So these are the key numbers to track on Wednesday. And shifting focus to Thursday, then we have names like Bajaj Twins, Ambuja Cement, Bank of Baroda, Biocon, PVR, as well as Tata Motors. Lastly, on Friday, we have the auto names like Bajaj Auto and Maruti that will be reporting numbers. Remember, the street is very keenly watching out for in case there's any sliver of hope in the numbers of any pickup. So we'll watch out for these numbers. And apart from that, JSW Steel will also report numbers. Apart from this, in the terms of the global setup, the US GDP data would be out on Friday, and that is something to track. Other than that, we have the IMF that will hold a press conference to talk about the World Economic Outlook update on July 23rd. And on July 24th would be the day when Theresa May would hand over the reign to the new Prime Minister. So that continues to be an important event to watch when it comes to the European markets. Back to you.
Come back here with us on Taking Stock. Joining in now is Ashwini Gujaral. It is time to look at the charts and talk technicals. Ashwini, it was a complete slam dunk, particularly the horrific session for the bulls on Friday. Given the huge momentum and the selling on the downside, how do you sum up the week and how do you look at things as they stand?
See, basically, the market came down sharply post the budget, and then we had some consolidation. And today it seems the downtrend has started, and the way this is going, I would not hesitate to call this a bear market, and we should fairly soon move towards the 200-day moving average on Nifty, which is about 11,150 thereabouts. The issue is that we are going to do this in double quick time because the large stocks are coming off, and it's clear why they are coming off and who owns them. So given the momentum with which this fall is happening, you would be careful in terms of looking at this as a buying opportunity. My sense is that the selling needs to stop before the market bottoms out. So that way, whatever rallies you get need to be sold into instead of trying to buy the decline.
Okay, I mean, we need to get the rally first, but Ashwini is saying that there is more downside. Ashwini, what would you trade in such a scenario?
See, basically, Kotak Mahindra today dropped almost 3%. So that's a sell with a stop of 1505, target of 1460. Trading closer to highs, chances are FPIs are long on Kotak. L&T Finance is a sell with a stop of 114, target of 102. And BPCL is a buy with a stop of 348, target of 364.
RIL, Reliance Industries, also posted its results after market hours. Why don't you take us through what the key highlights are?
Well, Reliance Industries came out with numbers that were largely better than what the street was estimating. The consolidated profits at over 10,000 crores was better than estimates of 9,850 odd crores. The Petchem segment EBIT was weak, but not as bad as what the street was estimating. So there was a positive surprise there as well. RelGeo margins were better than expected. And there was a big positive there that Brookfield will be investing over 25,200 crores in the Tower Infra Trust. Not just that, the retail earnings were strong in a challenging environment, so retail revenues went up by about 48%. So a lot of positives. On the negative side, though, you can say that gross refining margins at $8.1 a barrel was lower than what the street was estimating and lower than what we saw last quarter. So there was definitely some pressure there. Also in the telecom business, you did see the ARPUs fall about 3.3% quarter on quarter to 122 rupees. So that was a bit of a disappointment as well. But largely, you'd have to say that the street will take it positively and the stock may open higher on Monday.